Imagine this. Your parents spend 40 years saving for retirement. They do everything right. Buy a home, open RRSPs, even get a little cottage up north. Then they pass away, and the Canada Revenue Agency sends you a bill for $660,000. That's what happened to one Burlington family, and it could happen to almost anyone. Today, we're breaking down exactly how a normal, middle-class family lost nearly everything to taxes after both parents died, and what you can do right now to make sure it never happens to your family. Stay with me, because by the end, you'll know how to protect your inheritance before it's too late. The mother was a nurse. The father ran a small business. They weren't rich, just responsible Canadians who saved like they were told. Together, they built an RRSP worth over $700,000 and a cottage they loved. When the mother passed at 62, her RRSP rolled tax-free into her husband's name. But just months later, the husband died too. And that's when the CRA came knocking. Under Canadian tax law, when the last spouse dies, the entire RRSP is treated as income in that final year. The husband's return showed $715,000 in extra income. Added to that was the cottage's capital gains tax, because at death, every property you own is considered sold at market value. The cottage, bought for $150,000, was now worth $500,000. Combine that with the RRSP income, and the estate was pushed into the top tax bracket. The total bill, roughly $660,000. Their kids were left shocked. They thought Canada didn't have inheritance tax. Technically, it doesn't. But in practice, the system works the same way, just with a different name. Number 1, RRSPs aren't tax-free. They're tax-deferred. You don't avoid tax, you delay it. If you die with a large RRSP, the whole thing can be taxed in a single year at the highest rate. Number 2, deemed disposition. When you die, the CRA acts as if you sold everything. Your investments, your rental property, your cottage, even if you never did. That triggers capital gains tax instantly. Number 3, principal residence limits. You can only claim one home as your tax-free principal residence. Any other property, like a cottage, builds taxable gains over time. Stack these 3 together, and the result is brutal. Estates can lose half their value overnight. Withdraw RRSP funds earlier, starting in your late 50s, to spread taxes out over time. Shift more savings into TFSAs, which pass to heirs completely tax-free. Use joint last-to-die life insurance. It pays out when both spouses pass, exactly when taxes hit hardest. And don't wait until retirement to plan. The earlier you design your estate, the more options you have. The Burlington family's story is tragic, but it's also a warning. Saving isn't enough in Canada. You have to plan how those savings will be taxed when you're gone. If you learned something today, hit subscribe and share this video so more Canadians can protect their family's future. Because sometimes, the biggest threat to your wealth isn't bad luck, it's the fine print.